the speaker today is a gentleman by the name of Jack Goldberg. He works with Time Equities. The title of his panel is Opportunistic Real Estate Investing for 5 Decades and Beyond. Time Equities has been established since 1966, and it's thrived through bear markets and bull markets using a diversified opportunistic approach to real estate investing. Jack Goldberg, are you on the line with us today?
Yes, I am. Hi, everyone.
Excellent. So I'm going to stop sharing my screen, and I just ask that you put up your presentation.
Yeah, absolutely. I am ready to go as soon as you let me. All right, there we go. Okay. Get this up here. All right. So no tech blips so far. We're off to a good start. Michael, thank you so much for inviting me to speak today, and thanks everybody for joining me from wherever you are in the world. My name is Jack Goldberg. I'm the Senior Associate in the Equity Division at Time Equities. Really here to kind of give you guys just an overview and educational piece on how companies get through major market downturns like the one that we're in right now, like 2008, and how you can position your own portfolios in real estate for long-term generational wealth creation, as we've done with ours and with our investors. So without further ado, I think I have about 25 minutes or so. I definitely want to leave some time for questions. I first and foremost want to note that as well, that I'm really interested to hear all of your questions. So please don't be shy. Happy to answer any of your questions, broad, macro, micro, whatever they may be. Just type them in the chat box, the Q&A, and I'll be sure to cover them. Really, what I really want to cover today here is basically a high-level overview of who we are and why we do things the way that we do them. Talk a little bit macro and micro about what we're doing right now, and then show you some examples of deals that we're buying right now in this crazy buying market. Obviously, this being one of the more interesting market downturns that we've seen in our lifetimes. Everyone seems to be very unique, so we're looking forward to continuing to tackle this one with you. I want to note, so Time Equities, this is our corporate headquarters on the left-hand side. We're located on 13th Street and 5th Avenue in downtown Manhattan, Greenwich Village. We own the whole building. We've owned this building since the 80s. We operate out of the 14th and 15th floors, though. This is where I'm giving this conversation from right now. We've been back in the office for a couple months now, doing so as safely as possible. I'd like to take this time without going too much further in to make sure all of you are staying healthy and well. Our best wishes are going out to all of you. Our thanks to all the healthcare workers out there and anybody who's been affected by the ongoing craziness in the world right now with COVID and with everything economically. Hope everybody's doing well. Once this whole thing finishes, eventually gets better, and people are starting to come back to New York City, our doors are always open. We love having visitors. So if you're ever in the area, I'll leave my contact information at the end here. We'd love to have you in the office and get to know you a little better. So without further ado, I'm going to give a very high-level overview of our history and why we are here doing the things that we do. So Time Equities is a 54-year-old privately held real estate investment and development company. We were founded in 1966 by a gentleman named Francis Greenberger, who was 16 at the time. Francis is kind of a legendary player in New York City, and in the Northeast. Some of you might not be familiar with who we are with Francis, but he's kind of a legend in the space, at least up with us. Francis was 16 when he founded the company in the 60s, kind of a classic American entrepreneurial success story. He was buying real estate, syndicating deals with his father's family and friends. His father's company was failing. They had an office in Manhattan, and Francis at the time took it upon himself to actually go out and lease half of their unused office space to another user, and found that he was able to make more income for his father's company doing that than the company did in their own business in that same month. So quickly a light went off in Francis's head, and he started going out and raising funds from his father's friends primarily, and buying properties in Manhattan. in the 60s and 70s and 80s even. Many of you know New York City was not a great place to buy. It wasn't a great place to live. It didn't seem like it was going anywhere, especially with all of the, the rent stabilization laws that were in place up until the mid 80s. But that was the beginning of our investment philosophy. We were contrarian. We were value focused. So we were looking for cheap bricks that had good current income and an opportunity to grow that income over time if you can manage the property well enough. So fast forward to 2020, we're now a $5 billion real estate investment company. We have about 325 properties within our portfolio, equating to about 33 to 35 million square feet, either acquired or constructed. We do sometimes on occasion do construction projects, but primarily our focus is on acquiring income producing assets. And finally, we've been doing this. We've been raising capital from investors and co-investing with investors in these deals since the inception of the company. And in 2010, the equity department at Time Equities was born, and my team and I have been raising investor capital primarily through Reg D private placement funds, which kind of act as mini Time Equities operating vehicles. I'm going to get into that a little bit further. But just to give you an overview of the company even further. So as a company, number one, we are contrarian. We're also diversified. So our portfolio spans over 33 U.S. states. We were only investing in New York until New York became overpriced. We no longer could find the yield that we are chasing and that we really are contingent on in terms of buying an asset. So we started looking in other markets, doing so opportunistically, trying to chase that yield wherever and with whatever we could find it in. So starting in the 80s, really, we started diversifying our portfolio outside of New York, and now we're across 33 U.S. states. We entered Canada following the Quebec secessionist movement when Quebec wanted to secede, and there were tremendous buying opportunities in Quebec, Montreal, Vancouver. We entered Germany. Following the reunification of East and West Germany, there was about a decade there where everybody was kind of holding their breath, seeing if this was going to work. And because of that, there was so much uncertainty in the market that we went into major markets like Berlin. And again, we're buying properties for cents on the dollar. We've been investing in the Netherlands. We now have an office in the Netherlands, which is our full-time Western European office, feeding us deals from Western Europe. We just entered Scotland, and we're in Italy and Anguilla as well in individual functions. So really, we are asset focused, asset type diverse as well, geographically diverse. And the primary reason for this is we know from our 54 years of experience, and all of you know that real estate cycles are inevitable, right? They're going to come. We found one of the best ways to hedge against the cycles is to be as diversified as possible. Spread your risk across different markets, both macro and micro markets, as well as different asset types. So rather than focus on one asset type in one geographic location, Time Equities has really sustained itself primarily by focusing on what we consider to be the four main real estate food groups, which are, to us, office, multifamily, industrial, and retail properties. Quick update on this. Our portfolio at this point is relatively healthy. We did go through a few months there in the first few months of COVID where our retail collections had dropped substantially. That said, we're back to about 95% on our retail portfolio, thank goodness. Hope everybody else on this line is hopefully doing well in that front. But here at Time Equities, things are moving forward pretty well. And I think I'd attribute a lot of that to the diversification, but also the way that we buy assets. And that's something I'm going to get into briefly. This page, I just want to show all of you the kind of experience that we have, and that's one of the key parameters when I'm reviewing new investment opportunities in this market for my personal investments. I'm looking to invest with partners that have tremendous amount of experience and a know-how in how to get through downturns such as this. So I think we all know that in every downturn in 2008, we all said to ourselves, the world's ending. I've never seen anything like this before. In 2001, September 11th hit just down the street from us. Same thing. People said, oh, New York City office is dead. Nobody's coming back to the office. And there's been so many instances throughout our history where, everything seemed pretty drab and uncertain. But we found that in that uncertainty, if you have the experience and the know-how of what to do preemptively, as well as what to do when the situation occurs, you can really be, if you're courageous enough, you can really be opportunistic in times like these. And that's how really Time Equities has grown over time, is by being opportunistic, having the courage to go somewhere new, and using our experience and our investment philosophy to make sure that we're limiting the downside risk with every kind of move that we make. So when we're talking about all the different ways that you can hedge against the inevitable real estate cycles, we have really procured our investment philosophy by learning from our mistakes over 54 years, by learning from the real estate cycles that do occur. So I kind of mentioned, first and foremost, we are contrarian. That kind of was founded when we started investing in New York City, when it was a pretty not nice place to be or to invest. So we were able to find value where other people really weren't looking, where other investment firms were not looking. So that's first and foremost key to how we find great deals. Second is diversification. So like I said earlier, we know the best way to hedge against real estate cycles is to spread your risk as broadly as possible, rather than having all of your eggs in one asset or one geographic location. We prefer to hold a diversified portfolio. Next is our undervalued opportunities, kind of the situation where we're looking for value investing, meaning we're looking where others are not looking for the value. We believe in cheap bricks and the value of cheap bricks, as well as current income, which brings me to the next point: low price per square foot versus replacement cost. So Time Equities really is focused on trying to find acquisitions that we believe are cheap bricks versus what it would cost to build that property brand new. Then next is our conservative underwriting instance here. We know that if you overpay for an asset, the inevitable conclusion is that that asset will go under in a major market downturn, especially if you don't reserve substantially more than you originally think you may need to. So in this current situation, the real estate owners who are going to get hit are those who overpaid for assets just to be located in major downtown markets. I think it's very difficult to make a well-bought property work, but it's even more difficult to make a property work when you know that you've overpaid from day one, which is why buying it right is something that we have literally plastered on our walls here at Time Equities. And buying it right and on the buy is where we really feel like we make a lot of our money. But also, conservative underwriting means that we look for undervalued opportunistic assets because they typically have some form of current income. We're buying it either from a distressed seller, or the property is distressed, or we're able to buy a property with current income with great financing rates. There's a lot of different ways that we feel that we're building in a lot of underwriting conservatism into every deal. Most of the deals that we purchase are day one returning anywhere from 7 to 12% going in. But on our investments that we have with our clients, we only start distributing to most investors 6%. And that's because we believe that we want to make sure that we have enough cash on hand to have the staying power to make sure all of our properties get through major market downturns. That's probably number two after diversification. And the best way to hedge against the inevitable cycles is to make sure you have enough cash to hold that property through any downturns. But really, we like to have a lot of cash on hand. We like to sweep a lot of the excess cash flow above what we pay our investors into reserve accounts. And once we feel comfortable that we have a sufficient amount in cash reserves, we'll start increasing our distributions. But Time Equities for an investor really is, we prefer to be a company that under promises and then over delivers. We find that that's the best way to manage expectations. And then finally, a big kicker with TEI is anything that we buy, including the assets that Francis and Time Equities bought in New York City in the 60s, 70s, and 80s, we actually intend to own those assets forever. We truly believe in the value of long-term cash flow that is coming. It's sustainable. You start it low and grow it over time. But we feel that the best way to create sustainable generational wealth is by buying and holding assets rather than buying and selling them a few years later for a quick profit. Which brings us to this point here, which is key to the Time Equities philosophy and our growth and our sustainability, is the fact that we, rather than selling assets, to exit our capital, we prefer to use the financing markets, non-recourse financing on the individual assets once they reach stabilization. As a company, as I mentioned before, we do tend to be very cash heavy, which puts us in a tremendous buying position when opportunities are presented. We get preferential treatment a lot of the times and are able to buy properties at discounts because of our all cash position and lack of reliance on the financing markets to bring a property down. But once we stabilize that asset, we'll put non-recourse financing on it to exit some, if not all, of our capital from that property over time, because loan proceeds are tax-free versus a sale of an asset that you've improved the value on. Obviously, you're going to be hit with capital gains unless you do a 1031 exchange. So we would prefer to finance a property and continue to own it, pull out cash from that investment from the financing, and reinvest in a new deal, which it does a couple of different things. First and foremost, you're able to further diversify your portfolio. Second, you're able to de-risk your position in that original asset. You have less cash tied in that asset. If things do go south, you're at risk of losing a lot less than you were originally. And third, when you reinvest those financing proceeds, you're able to compound your yield, continue earning a leveraged yield on the original asset and earn a new yield on the second asset. And that there is the exact kind of nutshell how Time Equities and how Francis Greenberger, our chairman and CEO, have built ourselves into a very sustainable and healthy company 54 years later. It's by using this compounding snowball effect to really grow our portfolio, further diversify everything that we own, and make it so that we are comfortable going to bed at night because we know we're the owners of a self-sustaining portfolio of assets. So that all said, this is exactly the metrics that we've used for our own account. And right now, what I wanted to tell all of you today, most importantly, is that I mentioned earlier, we do investor syndications on a one-off basis, but we also entered the family office, broker-dealer, registered investment advisor, high net worth investor market with these private placement sidecar TEI funds, which co-invest in Time Equities properties alongside TEI. And I want to tell you about the opportunities that we're investing in right now. And if you want to get more details on the specifics of the fund and how you can invest, let's have a conversation after this. But I want to make sure that I share with you some of the stuff that we're looking at right now in an effort to get a yield and great future value for our investments. So typically Time Equities, and this first page is slightly misleading. Typically Time Equities, as I mentioned earlier, we buy existing assets that we intend to own long-term. And because of that, the buying part of owning that asset is the most exciting and most important part of the transaction. So right now, for the first 6 months of COVID, maybe even now, even into 9 months now, we weren't very comfortable with the valuations of real estate and the uncertainty in the market. While we are opportunistic and we do obviously take risks here and there, we're also extremely conservative and only take risks, hopefully like many of you, when we really know that the opportunity is there and we have a clear picture of what we're buying. Now, that said, there was not a clear picture of what we were buying for the first half of this year, basically, for the first 3 quarters. We weren't confident in the valuations. I don't think any of us are right now. Nobody really knows what the future holds, at least not here in the U.S., especially with the upcoming election and the uncertainty around 1031 laws. So for the first couple of months, we were looking for other unique, creative ways to invest our capital because we knew there was a major opportunity that presented itself. But long-term real estate ownership and long-term acquisitions was not really what we were looking for at that time. So the first couple deals that we actually were buying are in the real estate market. I'll start with the B note on the right-hand side. As all of you know, when major market downturns like this happen, financing dries up. And there were companies out there in the middle of projects who needed debt. And when the CMBS markets and the traditional debt markets dried up, they went to private companies like Time Equities. And we have a loan servicer partner that we work with who fed us this deal and many more. The moral of the story is on the debt position that we made here, we're earning 16% interest on a $1 million investment in this loan. The loan term is 12 months, meaning that we feel comfortable, okay, we're going to put our money to work, we're going to earn off of this property, and then in the 12 months, and it has 2 6-month extension options, we'll have our capital back And hopefully at that time, we'll be able to recycle it into new deals once the market has really, truly reset and the market has been filled with a bunch of different true real estate investments. Next is the preferred stock position we took. I'm sure most of you are involved in some sense in the public markets of real estate as well. Public markets and the liquid markets are the first market to be hit when a market downturn happens and to become distressed. Private real estate takes a few months, if not years, after a major event like the one we're currently going through to really hit the private players in real estate. So that said, we were all watching in March as the values of, or the stock prices of so many companies that are trading publicly dropped substantially. And it wasn't because of, a bubble. It was because of fear. The underlying assets were still relatively strong. So we saw an opportunity to basically invest in publicly traded REITs. And we did so using a hedge fund manager that we invest in personally, our chairman invests with personally. And that hedge fund is going out on our behalf. It's another short-term position, relatively liquid, that we can liquidate when we see fit. But this hedge fund is going out and buying preferred stock of publicly traded REITs that they believe are extremely dislocated currently to the par value of their shares. So another way to earn current income and also some value appreciation on that when the stocks go back, hopefully, to normal. I do see some questions coming in. I want to thank all of you for those, by the way. Keep them coming. I'm going to make sure I finish with these acquisitions here just to share with you some more kind of flavor of what we're seeing. We've been investing in Western Europe for the past 6 or 7 years or so right now. We entered the Dutch market in the Netherlands following the 2010 financial crisis. In that financial crisis, we here in the U.S., we recovered first. It hit us first. We recovered first. And the European markets, though they tend to be as sophisticated as we are, we're just lagging in their recovery because they recovered later than we did. So as a company, Time Equities, like I said, is always cash heavy. And in markets like these, debt financing, dries up, which means that the amount of buyers in a market is limited. And when you're an all cash buyer in a very limited buying market, you're able to get deals extremely cheap. But also, we love the Netherlands. It's a very sophisticated country with similar real estate rules, and let's say they're very transparent, similar to ours. So we've been investing in the Netherlands. This deal is an office property, suburban office, that we're able to purchase for almost $60 a square foot at 60% occupancy. And at 60% occupancy, we get a 7.16% cap rate. Meaning once we're able to grow the value of this asset and pick off tenants from surrounding offices by offering them lower than market rents because of how cheap we bought it, we're able to stabilize the property, get it to close to a 10% annual return on an all-cash basis, and then finance it, pull our equity out, and we're earning mid-teens returns based off of a almost doubled market cap. So those are really, that's a typical Time Equities deal. I'm happy to go into more, but I want to take a second before my time runs out here to answer some questions. So, Michael, does that sound good to you? Does now seem like a good time to start opening it up to questions?
Yes, absolutely. This is a perfect time to open it up for questions, Jack.
Great. So I'm going to take a look through here. Also, by the way, we do sponsor 1031 exchanges, not only within our fund, but we do have 1031 exchange solutions and direct investments. If anybody's interested, I'm just going to get us here. I'm supposed to leave that going, but I'll get us here to my page here with my contact information, so you can reach out an email. So let's see. Can we have more details of the TEI fund? Yes, absolutely. I'd like to reach out to you after the fact. The fund is really, let's see, and I want to see if there's any other questions. Copy of presentations, gotcha, no problem. So going back to our funds, the way that it works is, these are Reg D for accredited investors only funds. And the funds are co-investing with us. We have a minimum of $50,000 of a minimum investment, so relatively low threshold. But the way that the funds work is they buy partial interests in a variety, if not almost every deal that Time Equities is buying for its own account. So we have about 16 million raised of the total 100 million so far. And what we do is we allocate the money as we raise it to the deals that we're buying today. So they're not old deals that we're picking out from our portfolio, we're creating actively a portfolio for this fund so that it's going to be invested in partial interests in roughly 20 to 30 different assets. So you get the diversification, you get exposure to both income producing and more opportunistic deals. And of course, right now we're in an extreme opportunistic buying market, or we will be eventually once the moratoriums start to be lifted and owners start to have to give back their properties to the banks. I think that's really when the opportunities are going to pop up. Now that said, even more so on the fund, just want you to know, so we start our fund off at a 6% preferred return to investors. The goal is to send out bonus distributions at the end of each year. We will also then send the fund investors their portion of the financing proceeds, right? So it's like an annuity, but with upside, where we start distributing at a 6% return, which is much better than any annuity you'll get right now. But the goal is to return the investors' capital by the end of roughly 7 to 10 years. And we do that through a combination of the income that we send, bonus distributions, and finally financing proceeds. Since most of the deals we're purchasing are buying on an all-cash basis, it gives us the opportunity to finance those properties after the fact, send capital back to investors in a very tax-efficient manner, and then they're going to continue receiving ongoing income distributions while having all of their money out of the deal. And they'll get those income distributions and future financings and refinancings as we continue to finance value out of those properties. And that's a model that we use in perpetuity. So if anybody has any more questions on a TEI fund, I'd be happy to share more details with you. Just shoot me a quick email and we can have a further conversation. Another question that just came in was, how do we see our Italy or how do we see our outlook in Italy? So in Italy, we actually made a non-performing loan acquisition. We bought a discounted loan pool of non-performing loans for about 25 cents on the dollar back in 2018. So the goal there is actually not to take over the real estate. We've been working on a settlement plan with a majority of those tenants. Of course, Italy was hit extremely hard at the beginning of COVID. For any Italians on the call, I wish you all the best. I hope everybody in your family is doing well. But it's a long-term play for us. Of course, Italy, we went into it. We did purchase it for an extreme discount. So our ability to make money on this is pretty high because of the discount that we purchased it at. But it's just a waiting game for us there. In terms of the UK, would we consider the UK? Yes, we actually are actively looking at deals in Ireland and the UK. It does tend to be a little bit pricey. And Brexit does have a lot of uncertainty, but uncertainty is a place where, of course, we can make a lot of money. So, yes, we did just make our first investment in Scotland. We bought a retail property in Inverness, Scotland, which is the Northern Highland regions, which is an area that's not well reached by most e-commerce companies. So they're still reliant on the local retailers. So we really like that deal. We purchased it at a roughly 9% cap rate day one. So certainly we're going to continue to look at the UK. The next question was, do we have a criteria of how much we invest per each country? Correct me if I'm wrong in my understanding of that question. But in terms of our criteria in what we invest in, how much we invest in any foreign country, as a company, we just like to be balanced. The current situations do change. And we like to be investing in countries that we know are sustainable, that they have a long track record of successfully doing business. That's the Netherlands right there in a nutshell. But in terms of spreading the risk across the United States and internationally, we feel it's a great hedge to make, especially with the uncertainty going on in our market right now. We've been actively investing in Western Europe. We haven't even purchased any deals in the U.S. We have 3 now for Fund 5 in Western Europe. And that's simply because they're in a better position right now than we are. It sounds a little bit like they're going back into hiding, into quarantine, and things might be on their way back in terms of COVID. But we're really happy with it, and we're going to continue to look for Western European deals and try to hedge our domestic U.S. Situation here. Michael, I know we're probably on the cusp here in terms of timing. Do I have time to answer one more question?
No. We have the next panel that's up right now.
Gotcha. All right. Well, hey, Frank,
I'll send you all the information that's coming in through the Q&A and through the chat, and you can follow up with them directly. It's going to take me a couple of days to process the information, but will you make a copy of your presentation available?
Yes, absolutely will.
All right. Thank you
So
so
anybody
much.
who wants to hear more of the presentation or want to talk with me further, just shoot me an email or we'll work through this. Thanks everyone. Thanks Michael for the time. Hope everybody stays well and talk to you all soon.
All right. Thank you very much, Jack. Thank you for
Thanks.
the presentation. It was excellent.